A year ago, if you mentioned NIO to most investors, the reaction was usually the same. People didn't see a future industry leader. They saw a company trapped in one of the most competitive markets on earth, losing money while rivals seemed to get stronger every quarter. The stock had collapsed more than 90% from its all-time highs. Confidence was gone, excitement had disappeared, and many investors had already written the company off. Yet while the market was focused on artificial intelligence, semiconductor stocks, and the next big tech breakthrough, something unexpected was happening inside NIO. The company wasn't making headlines every day. It wasn't generating viral excitement. Instead, it was quietly doing something much more important. It was executing. Month after month, quarter after quarter, NIO started producing the kind of results that investors had been waiting years to see. The first sign appeared in the one area that matters more than almost anything else for an automaker: demand. Because no matter how advanced your technology is, no matter how beautiful your vehicles look, and no matter how many awards you win, none of it matters if customers aren't buying your products. For years, critics questioned whether NIO could ever achieve the scale necessary to compete with giants like Tesla and BYD. But recent numbers suggest that those concerns may have been overstated. In December 2025, NIO delivered more than 48,000 vehicles in a single month, setting a new company record. For many businesses, a record month would be enough to generate excitement. For NIO, it was simply the beginning of a much larger trend. February deliveries increased nearly 58% compared to the previous year. March deliveries surged an incredible 136%. Then May arrived with another powerful result, showing growth of more than 62%. These weren't isolated successes. They represented a pattern of accelerating demand that began changing the conversation around the company. For years, investors questioned whether people still wanted NIO vehicles. The latest delivery reports provided a very clear answer. Demand wasn't disappearing. It was growing. And perhaps more importantly, it was growing at a time when competition in China's electric vehicle market had never been more intense. That alone was impressive. But what happened next was even more important. Because growth, by itself, isn't enough. Investors have seen countless companies generate impressive revenue growth while continuing to lose money. Eventually, markets stop rewarding growth and start demanding profitability. For NIO, profitability had become the ultimate challenge. It was the milestone that skeptics believed the company might never reach. Then something changed. In March 2026, NIO reported its first GAAP net profit. After years of losses and criticism, the company finally crossed a threshold that many investors thought was still years away. The discussion was no longer centered around survival. Instead, investors started asking a completely different question. How profitable can NIO become if current trends continue? That shift in perception matters more than many people realize. Financial markets often reward future expectations more than current results. When investors begin to see a company as profitable rather than speculative, valuations can change dramatically. And NIO didn't stop with a single profitable quarter. In Q1 2026, revenue increased by more than 112% year-over-year, reaching over 25 billion RMB. Gross margins climbed to approximately 19%, while vehicle margins approached some of the strongest levels seen in recent years. NIO wasn't simply selling more vehicles, it was becoming more efficient. It was improving margins while expanding production. It was generating more revenue while moving closer to sustainable profitability. That's exactly the combination investors want to see from a company entering its next phase of growth. At the same time, NIO was preparing one of the most aggressive product expansions in its history. The company wasn't relying solely on existing vehicles to drive future growth. Instead, it was introducing new products designed to strengthen its position across multiple segments of the market. One of the most important launches was the ES9, NIO's flagship luxury SUVs. Positioned at the premium end of the market, the ES9 is intended to reinforce NIO's image as a high-end brand while supporting stronger margins. Premium vehicles often generate significantly more profit per unit than mass-market alternatives, making the ES9 strategically important for the company's financial future. But while the ES9 attracted attention, another vehicle may prove even more significant: the ONVO L60. Unlike the ES9, which focuses on luxury buyers, the L60 targets a much broader audience. This matters because volume drives scale, scale drives efficiency, and efficiency drives profitability. If the L60 succeeds, it could help NIO reach a larger customer base while accelerating growth across the entire organization. Beyond vehicles, NIO possesses another advantage that sets it apart from almost every other electric vehicle company in the world: battery swapping. For years, many industry observers viewed battery swapping as an interesting idea with uncertain potential. NIO, however, continued investing heavily in the concept. While competitors focused almost exclusively on charging infrastructure, NIO built an entire ecosystem around battery replacement technology. Earlier this year, the company announced it had completed its 100 millionth battery swap. Think about that number for a moment. 100 million swaps. That's no longer an experiment. That's evidence of large-scale adoption. It represents years of investment, infrastructure development, and customer engagement. CEO William Li has repeatedly emphasized the importance of infrastructure as part of NIO's long-term strategy. His vision extends far beyond selling vehicles. He sees NIO as an ecosystem combining vehicles, software, energy solutions, battery services, and advanced technology. Whether battery swapping eventually becomes a global standard or remains a unique differentiator, it already provides NIO customers with an experience that few competitors can match. Wall Street is beginning to recognize these developments. Several major financial institutions have become increasingly optimistic about NIO's future. Macquarie upgraded the stock and raised its price target. HSBC upgraded its rating to buy. Morgan Stanley increased expectations. Nomura became more bullish as well. Today, the debate is becoming something very different. Can NIO become one of the dominant premium EV brands in the world? The answer will depend on future deliveries, upcoming earnings, new vehicle launches, international expansion, and continued progress toward profitability. But one thing is becoming increasingly difficult to ignore. The story has changed. NIO is no longer simply trying to prove it belongs in the electric vehicle industry. It's trying to prove it can lead it. And if the company continues executing the way it has over the last several months, investors may eventually look back at this period as the moment when the comeback truly began.